Now, everyone, welcome Zachary Manis, Senior Analyst, U.S. Equities, ElliottWaveTrader.net. It's going to be a great presentation, Zach. Thanks for being here. It's all yours.
Thank you very much, Mark. I appreciate it. Sorry about being a little bit late. I had it down in my calendar as 4:55 start time for some reason. I think maybe I inserted it when I was at a family event in Nashville the other week. So we're going to be talking about how we use Elliott Wave in our wave setups to identify opportunities and particularly looking for rotation. Before we get started, I like to look at some basic Elliott Wave stuff just to give you guys a frame of reference of what we're talking about. And Elliott Wave, we're looking for patterns, recurring patterns of 5 waves and 3 waves. We have motive structures that advance a pattern in a 5-wave move, and we have corrective waves that retrace that in a 3-wave move, usually labeled as an ABC. It gets a lot more complicated than that, but that gives you a good basic of what we're looking for. The other important thing to recognize is that the same structures, the same A wave, for example, will be a smaller ABC move, and the same C wave will be a 5-wave move at a smaller degree. And similarly, the wave 1 and wave 2 here would look like this entire structure, the 5 up and the 3 down, at a smaller scale. We can further divide Elliott wave patterns into impulses and diagonals. These are the 5-wave moves. Impulses are strong trending moves that don't have any overlap, and all of the subwaves that are in the same motive direction are going to be similar 5-wave moves. We also have diagonals, which are much more compressed and overlapping patterns, where all of the subwaves, not just the waves 2 and wave 4, are 3-wave ABC moves, and often there's going to be overlap between the wave 4 and the wave 1. A lot of people shy away from those types of structures. Sorry about that. But we tend to see them as being just as reliable at times if you know what you're looking for. And also, if you are trading each of the individual legs, sometimes there can be more opportunities for individual trades and overall more linear movement. One of the advancements to Elliott Wave that I think our founding member, Avi Gilbert, brought was his understanding of Fibonacci pinball. So, of course, Prechter and Aaron Elliott himself talked a lot about the Fibonacci extensions of a 3rd wave going to the 1382 or the 1618 fib extensions. But what Avi recognized was that the subwaves inside that 3rd tended to go to very specific levels with very high regularity. And that was where the subwave 1 would often go to the 382, the 0.50, or the 618. Then you'd get normal consolidation for a wave 2. Then the 3rd wave of the 3rd would go to either the 100% or the 1236. And then normal consolidation rules for wave 4. And then the 5th of wave 3 would go to that 1382 or 1618. This started to happen so frequently that we really could set our clocks by it and use that to identify when things were starting off correctly and when we could have reliable structure for follow through and an impulse, or when we might get early signs that we were either dealing with a C wave or possibly a diagonal structure and not actually an impulsive move. We also place a lot of emphasis on looking at things by degree and on the fact that Elliott wave is fractal and that your equation has to balance. So one of the things that we notice a lot with people who just kind of casually try to apply an Elliott wave count without really digging in and looking deeper is that they'll just pick a couple of highs and lows and start to add some labels without zooming in to look at the smaller structure and make sure that you have agreement in a balanced subwave structure at all of those different levels. So we break things out, we talk about them by degree, or we just talk about like a circle wave 1 instead of primary degree. But we're going to be looking for that 5-wave structure inside almost every motive wave, or particularly 3rd waves. And then even inside that 3rd of a wave 3rd and all of the degrees, we're looking for the smaller degree structure and then breaking that out even smaller. We do have a lot more resources, education resources that are available for free at our website. This will take you to some of the helpful guides and some webinars and some other information there. And from there, you can poke around and have some fun on our website, but don't have time to get into too much of the nitty gritty. Today, we have a lot of other resources for beginner Elliott Wave stuff there. Before we jump into talking about individual setups and individual sectors and stocks, wanted to take a minute to look at this chart from Garrett and give you guys some broader context of what we see. Back here in the 1930s, shortly after the Great Depression, or during the Great Depression, was when R.N. Elliott actually came up with and produced his Elliott wave theory. It was a modification of Dow theory. And at the time, despite things being as dire as they were in the huge stock market crash of 1929, Ralph looked at things and saw the potential for that being a very large super cycle degree wave 2 and setting up for, at the time, he predicted a 70-year bull market. Now we've gotten some extensions inside the fifth of wave 3 for that move, and now are currently getting some nice extension in the cycle degree wave 5 of that super cycle wave 3. But at most degrees, that largely has played out and counts very nicely as complete, with agreement at lots of the different subwaves. So this doesn't mean that we're topping imminently, but there's certainly room for extension higher, and we're going to look at those opportunities to give us potential for extension higher. But we do take this into account in looking at the overall risk skew of the market and how we approach different setups, and maybe that we always try and have a couple of short setups in our pockets as well, saying, okay, if things are going to start to break support, where are those weak points going to be first? Stockwaves does a number of things. Most, I think, crucial to the heart of Stockwaves is our wave setups. These are applying the ongoing Elliott wave analysis that we do with a very directional bias and giving specific targets and support, invalidation, and resistance levels. And as those reach their resistance and target levels, those support and invalidation levels are updated, and new resistance levels and sometimes new target levels are assigned. We also have a request symbol tool where members can ask for updated charts on anything on demand, as long as it fits into the scope of coverage for Stockwaves, which is pretty much all US listed equities and sector ETFs, with the exception of the mining stocks that we cover exclusively in our metals, mining, and agriculture service. We also have nightly videos. We put out videos on Tuesdays, Wednesdays, and Mondays, Tuesdays, and Wednesdays. And then on Thursdays, we have a weekly webinar. In that webinar, we delve down into a specific sector and then the key components of that sector, looking for the things that agree with the sector as a whole, or where the strength or weakness might come from, especially. And then we also do every once in a while, we do a review of all of the sector ETFs. And then we look at things that are going to report earnings either later that day after the market closes or before market opens the next day, and look for how that earnings announcement could function as a catalyst to accelerate a part of the Elliott wave count, or at least to just provide some larger degree context. I mentioned that sometimes we do special updates, and this is one of the things that I wanted to talk about for our presentation today. Back at the beginning of April, we noticed a possible breakdown of some initial support, but a clear corrective ABC move down in the broad market that was setting up for at least a bounce, and many things that still had potential to make higher highs over their February and March highs. So Stockwaves put out a special update saying, how is one more high even possible? And outlining a lot of those names that either fit into two lists, and then we expanded this a little bit more with a webinar the next day, special early webinar on that Tuesday. But the list one was things that had a strong setup to make new highs. And list number two was things that might not necessarily be set up to make new highs reliably off of the April low at that point, but that were at least due for significant bounces. And one of the things that I pointed out in that follow-up webinar the next day was that many of the names in that second list actually had potential for stronger percentage moves off of those April lows than some of the things that might just be getting the first wave of their either 5-wave pattern for a fifth or an ABC pattern if it was the fifth of a diagonal, which we'll look at some of those charts shortly. Let me go back real quick there. So a couple of things that I highlighted here that we'll talk about today. RSP as a whole, we don't actually look at any of the main index ETFs in stock waves. That's covered in the main market service. But we do look at RSP, which is an QQEW, which are equal weight versions of the SPX and the NASDAQ. And those kind of smooth out some of the distortion that you might see from that Magnificent Seven and some of the other weightings that the S&P suffers from. We also looked at a couple of ETFs, XLU, XLI, XLY, IHI, and XRT, as well as XLC, and then a couple of individual stocks that we'll look at as well, BlackRock, CAMT, AMD, and that would be it. So here is a snapshot of our wave setups table. This was looking at the wave setups that we posted back in April. And so you can see in early April, we had some of those names that were on the list and a couple other ones posted along the way. Most of those were long setups. A few of those were some short opportunities, Costco and Walmart in there. But most of the setups that we were posting in April were long opportunities looking for either the first move of that move to new highs or the more part of that more significant bounce. So this is going back to April 7th and looking at what we were seeing in the RSP, that equal weight S&P. And I try to eliminate alternative counts on my charts as much as possible. When I do post an alternate, I try and show where there's going to be overlap and get people to focus on the point where there's most agreement. So I mentioned that there were some charts that argued for getting moves to new highs. A lot of those were diagonals, where the move, that fifth wave up to a new high off of the April lows, was going to fill out as an A, B, and a C wave higher. So that A wave structure most of the time is going to be an ABC move, which would target the same general region of resistance for a possible corrective B wave bounce. So on many of the charts that we're going to look at, if they are leaning more bullish, they'll have an A wave in this region, and they might have an alt count as like a yellow B wave or something. And some where it looks like the drop down maybe was a little bit deeper than is comfortable or reliable for a fourth, leaned a little bit more to only getting a corrective bounce, but that was the focus, that initial region for just the A wave off the low. XLI was one of the ones that argued for getting a higher high, but again, ideally counts best as an ABC up for this wave 3, so it should also get an A, B, and a C wave for the fifth wave. XLY allowed for a little bit more of a drop potentially in that C wave of the wave 4, deeper than ideal for a fourth wave, but the primary count here was to get an A wave up as part of an A, B, and a C wave, which is off of the chart here from back in April, over the prior high from the 3rd, which it made in December of last year. XLC, the communication ETF, this is from the webinar on April 8th, was looking good for at least that B wave bounce, and also possible to get the same ABC up as the B wave bounce, but for that to count as the A wave in the fifth wave up to a new high. XLU from also April 8th allowed for a little bit lower in what would be an A, B, and a C wave down. If this was all of that move at the April 7th low, then it needed to count as a WX and then an ABC for a Y wave. Not quite as reliable, but it is into a normal part of fib support for a fourth wave, and that would be looking for a new high up towards the 90 region, also as an ABC move. XRT was an interesting chart at the time. It was probably one of the more bearish charts that we saw out there in terms of the sectors, looking like 5 waves down for a possible wave 1 start in a C wave to the downside. But even though that was probably the most bearish chart that we could identify into early April, it was looking for a pretty substantial ABC bounce back up into the 71 to 75 region would be the most normal fib retrace support. I say support, even though that is a move up into resistance. We talk about shorts as the opposite way. So just like we have 5 waves up and we look for a retrace as an ABC to support for the wave 2, to the downside, we're looking for a bounce as an ABC bounce up into support. IHI also from April 8th. Here it was a little bit interesting because we don't have the cleanest 5-wave move down structure. This can count a little bit more like an A, B, and a C wave, meaning that this larger degree C wave would be a diagonal. And if we're dealing with a diagonal for that larger C wave, then it means that this wave 2 is probably going to be wider and even higher than the typical 50 to 60%, 50 to 61.8% retrace, sometimes even coming up to the 76.4 retrace or higher. So that was another name that, even though the larger structure looked more bearish into as the start of a bigger move down into April, it too is due for a pretty substantial bounce. So here we have an updated chart. This was from July 7th when I started making the slide presentation, but it only got a little bit more extension since there, but shows that A, B, C filled out, but past any reliable resistance for the white B wave. That really needed to hold in the 179 region to reliably be a B wave top, even though technically we're still under the prior high from November, December, but much more likely that this is an A wave, particularly with the slight extension higher towards the 186 region that we have over the next week, over the last week that we've gotten, but looking for an ABC retrace into reliable support region in the 160s to set up a nice new swing move that's probably going to take it to 200 or higher. XLI is interesting, and it filled out as an A wave, but because it actually stretched that A wave nominally higher than the wave 3, there is a risk that instead of this just being the A of that ABC move up for the 5th that we were looking for, that it could actually be all of the wave 5. So here it's even more crucial to see a clear ABC retrace into support in that 135 to 125 region to reliably set up for a move higher. And right here, the risk skew is very unfavorable. XLY that we had looked at off of the April low did get that ABC up into the resistance for the A wave of its parentheses wave 5. Unlike a lot of other names that actually got much closer to prior highs or even over prior highs, the consumer discretionary ETF is holding resistance that could be that yellow B wave. It still is an alt. We're going to first look for corrective structure to come down and hold support in the 190s to set up that next swing move higher. But if we see something that starts to turn down more aggressively under the 200 region, instead of a corrective looking ABC move for this A wave, then that'll be the first warning sign that this might not hold. And XLC, very similar to XLI that we looked at, where it also did make a nominal higher high. So if this is the A wave of the green parentheses wave 5, we should hold support in the 90s as a B wave. Because it's only nominally higher and we're dealing with a 4th wave at the intermediate degree, it can actually still count as a B wave at a nominal higher high. And it too runs the risk, like we discussed on XLI, of actually being all of the 5th because it is higher than that wave 3. So again, we're looking for a corrective ABC consolidation in order to set up another reliable swing move after it filled out more than what we initially had wanted to see off of the April low. XLU, actually a chart from just a little while ago because it got higher than this B wave from 2 weeks ago, and really runs the risk now of being all of a more muted version of the fifth wave with that pop higher than the wave 3 as well, similar to what we were just discussing on XLC and XLI. But this could still be the B wave of a wider flat for this B, and then still get the C wave up into the 90s for more extension there. And then XRT has pushed even a little bit higher from this chart from July 7th. And, as a wave 2, it still is valid as a 5-wave move down for wave 1 and a corrective bounce as wave 2. But getting past that 78s region makes it less reliable that it is going to hold at a lower high as the wave 2. So we really need to see a smaller, clear 3-wave move down and 5-wave move down and 3 waves back up as a 1-2 start to any possible larger third, for that to be more reliably bearish. And then we have IHI, also held as the wave 2. It did get up into the 7.6 for retrace, a little bit past it, but actually looks to have truncated. And it's actually filled out a little bit more off of that potential lower high as the wave 2, since this chart from July 7th. So this is one of the names that we are looking at for potential market weakness, even as other things might be getting a corrective retrace into August, September that's going to hold support. This is one of those names that could fill out the same pattern into support, but has a greater chance of starting something a little bit more bearish. So now going to look at some of those wave setup examples that we talked about. This is one on CAMT that was posted the next morning after that April 8th webinar. So here, one of those structures where this is one of the names we were only looking for the B wave bounce. But the risk reward off of the low that was made, we had a really good looking count as 5 waves down for the C to complete the larger A wave, and had a reliable target zone for the resistance for that B wave, that should be an ABC up. And I mentioned all of our wave setups will say that they have this little box that gives you the name, the type of setup, whether it's long or short, a support region, an invalidation level, initial resistance, which for this was the 58 region, which would be getting over that recent high in the A wave, and then a target, which initially was just the 69 region for more of this A wave, as well as a time frame. This was a shorter time frame wave setup. W stands for weeks. We also have M, which stands for months, and Y, which is year or years, although most of our wave setups are not meant to take more than a year. And then we give a ranking. Because this was a corrective bounce and only had a small amount off the low, it was given a smaller ranking of only a 2 on a scale to 4. Fast forward a little bit, though, into a more recent chart from just earlier today on CAMT. Not only did we get that first move up into the 69 region for the A wave, we held a corrective consolidation for the B wave, and then has filled out the rest of that C wave up into the 618, or a little bit higher than the 618 for the parentheses B wave. So that was a really nice move, up well over 65% from the initial wave setup. When we hit that 69 region, we updated with support for where the B wave should hold and a new invalidation level, and gave it a secondary target of 92 region for the rest of that C of the B wave. This was also from April 9th. We posted a wave setup on BlackRock. This probably exemplified the potential for that ABC up for a 5th wave that we're seeing the most of the time on the XLF chart, for that 5th wave to new highs. We have the alt on the chart of the B wave. Sorry, it's a little bit cloudy or not clear. I took the screen grab from the wave setup post instead of the actual chart from that day. But again, we can see in our wave setup box, support at 794, invalidation 699, initial resistance at 880. That was just shy of that was for this A wave of the A wave, in our C wave up, and a larger target of the 950 region, which was where the confluence was for the A wave of the fifth, or the possible corrective bounce as that larger B wave. This was given an M for months as the time, and a 3 because we were looking, because it was holding nicely as the fourth wave in a larger structure, looking for that fifth wave higher in a C wave. Fast forward to 2 weeks ago, we've actually faded a little bit off of that high, but we filled out most of that A wave into or exceeded our target of 950. I don't remember if we raised and added a secondary target or not when 950 was hit, because that was easily completing an ABC up for this fifth wave, and it just got extension from there. So hitting some fibs nominally higher than the wave 3, but it's really nominal. So I think there's a good chance that this should hold the 900s as a B wave and then get a C wave up into the 1200 to 1300 region. But at that point, it would be a new wave setup because the target for that has certainly been hit. CPA is another one that I wanted to take a look at. This is from April 11th. Also shortly after that webinar, we had a really nice triangle completing for a B wave. And this was due to play some catch up with DAL and UAL and some other charts in the JETS ETF, looking for a move up as wave 1. And I wanted to highlight this because here was something that was very, very different from a lot of the other charts that we were looking at in many of the other sectors. And this C wave was projecting up substantially higher, but the move that looked like it was going to have the greatest confluence with the other bounces and things that we were looking for off of the April low was just this wave 1 targeting into the 110 region, which was used as, well, 101 was the first resistance. But that's what I wanted to focus on in this 4-hour chart for the wave setup. And indeed, that is what is filled out into, we actually did get this pop higher since July 7th to the 114 region, but we filled out as 5 waves up into that wave 1 target of that larger C wave, and are now looking for, while other things, that was an A wave, and they're looking for an ABC consolidation into August or September as a B wave. This would be looking for similar consolidation, but as this smaller degree wave 2. And then the last wave setup that I wanted to look at, and then hopefully we have a little bit of time, Mark, for some questions, was the wave setup for AMD, posted on April 22. This was already a week or so after that April bottom. We'd actually been short AMD as a wave setup from back in October of 2024, and that hit our targets, and we tightened up the support and invalidation levels on the short side. And then after that April move, the initial move off the April low into April 22, we were holding a nice corrective consolidation as the AB start to the larger A wave in this larger B wave we were looking for, targeting the 131 region. And then fast forward to today, we filled out that C wave of the A wave and then got a less than reliable consolidation at the time, but then filled out another 5 waves up and exceeded that 131 level for the larger degree B wave. And it looks pretty good as complete. There is still some chance that this was just a much bigger version of this A wave, but getting to the 618 or the 764 makes that very unreliable and far more probable that this is trying to complete all of the larger B wave. I have one more. IBKR was set up into April 23 as a nice AB start to what could be just wave 1 of an ending diagonal for the 5th, but definitely looking for a move higher in the 5th wave, and even possible that it was just a wave 1 and a wave 2. Looking for the target of 260, which is just nominally higher than the parentheses wave 3, and the other parameters they were given. And then we filled out the more accelerated path, but looking slightly more muted. It did have a split, so this is the split adjusted chart. Allows for a 4th and a 5th wave up, but should be more than just that blue wave 1. It needed to hold around here as the blue wave 1 and get a wave 2 to get that more extended move that would be targeting roughly into the 90s. Here it looks like we can get a 4 or 5 up towards the 75 region still. So I do have, I have a couple other charts we can look at, but I wanted to see, Mark, if there were any questions and before we run out of time completely.
Yeah, all right. Thank you so much. We did have a question roll in here. They're wondering, how can risk management principles be applied with Elliott wave framework, especially when dealing with potential alternative wave counts or unexpected market movements?
So, I mean, we talk about using layers, but particularly with our, with our wave setups in particular, I think we can go back and look at one of those as an example. Oops, why is this not letting me go back? There we go. So here we had a structure, an A and a B wave structure, or a possible 1 and a 2 in the start of that fifth wave. So we showed invalidation level is 152. If it broke under the 152 level, then it was certainly not the start to this C wave up or the wave 3 off of that low. So you had really good risk reward targeting up here into the 260s for the rest of this move to head higher, with a much tighter stop in that 152 when this was at 168. And ideally, the 158 support level would be held for any consolidation here before even that invalidation level was hit. So I think by nature, the way that Elliott wave presents itself and the fib extensions that we look for, most simplistic Elliott wave structures are by nature going to have about a 1 to 3 risk reward on its own at the purest Elliott wave parameters. And when we do our wave setups, we try and apply some probability metrics that make it a little bit more reliable and more favorable, whether we're looking at a smaller degree subwave structure to add a little bit higher supporter and validation level that can really refine that risk reward even more favorably.
All right, excellent. Just about a minute and a half remaining there, Zach. Is there anything else you would like to go over in the meantime?
I included a couple other charts here, is like the XLF chart, where again, a lot of these, all of the reliable structure up the April low is filled out, but with most of these, not a lot of support has broken yet. So there are things that we're looking for, and we're constantly updating support levels and looking at charts on a daily basis and even more granular levels. And part of the things are recognizing the difference between something that is a shortable move versus something that is let's move more to the sidelines or trim and raise stops and look for that clean consolidation that sets up for the next bullish move, as opposed to trying to trade and force every move and aggressively short something that's not ready for that.
All right. Well, thank you so much, Zach, for taking the time out today. Greatly appreciate it, as always. Let's do it again soon.
Thank you very much, Mark. My pleasure.
All right. And a big thank you to everyone in attendance today for Money Show's Virtual Expo, Global Investing Opportunities and Risks. Stick around for more great content coming your way on the second day of the event. Will be the last day, so be sure to log on early and watch these fantastic presentations that will be taking place. So I will talk to you again then. In the meantime, everyone have a great evening, and we will talk to you soon.